Good morning everyone and welcome to another episode of Morning Markets here at Trade Potential. Now the month of October is past, but it marked a generally strong month for equity returns across global indices. The month had begun poorly, but there was a genuine change in sentiment through the middle of October. Now what caused that? Well, there is a developing belief across markets that central banks are very much near the end of the hiking cycle for interest rates, and that is that by the end of this year, most major central banks will have completed their interest rate hiking cycle and will look through 2023 to see how inflation falls and how fast it falls. Now this will have genuine profound consequences for global asset returns should this materialise and should central banks be willing to accommodate higher inflation than their targets suggest. And we'll finish with that subject. Overnight, we have had some constructive news out of China. Now it's unsubstantiated, but there is a suggestion that the government there have appointed a central committee to investigate the possibility of gradually reopening the economy from COVID lockdowns by March of next year. Now this all seems quite far away, given how Western economies have almost fully reopened and are enjoying life. But in the context of very poor economic sentiment within China, it suggests a more constructive first step from the government, and that by the spring it would be possible for some of their citizens to travel out of the country, and indeed foreign nationals to travel in without facing punitive quarantine restrictions. It's a step in the right direction if follows through with regards to reopening the economy, and that would have profound positive consequences for global growth, but also profound consequences for global commodities demand. If activity in China was to accelerate because of looser restrictions around COVID, it suggests more economic activity, and that would be higher demand for commodities as that economy there tries to return to what would be a new normal. Now bringing that together with the change in equity sentiment and the likely or the possibility of a change in Chinese sentiment, it does suggest there may be continuing inflationary pressures through next year. However, most central banks have already forecast this. Overnight, we've had the Reserve Bank of Australia raise interest rates by 0.25%. That was in line with market expectations. But perhaps unusually was their forecast for inflation to still be above target by the end of 2024. Now, the Reserve Bank of Australia join the ECB, the European Central Bank, and the US Federal Reserve in all forecasting inflation to be above target through 2024, so 2 years hence, but perhaps no longer hiking interest rates next year. In fact, aside from the Bank of Japan, the only major central bank which forecasts inflation back to target in a timely manner is now the Bank of England. And this has profound consequences for global interest rates should central banks be willing to accommodate much higher inflation next year and through 2024. It suggests that despite tough rhetoric from central banks with regards to inflation, they are unwilling to push economies to the brink of recession in an effort to try and protect the full employment that all of these major economies are now enjoying. Now, recall the European Central Bank last week hiked interest rates by 0.75%, an unusually large interest rate hike from them, but indicated that the majority of tightening is now done. So they have indicated that they are willing to accommodate higher inflation next year, very much a wait and see approach. The Reserve Bank of Australia have indicated the same overnight, and tomorrow we get an update from the US Federal Reserve, where, as I've mentioned, sentiment is building towards a form of pivot. That is, the central bank is willing to communicate that they are almost done. The challenges in the UK are somewhat different. Fiscal policy here is much tighter than in other global economies, and news overnight from within the government indicates that there may be some more broader tax hikes in the pipeline, which suggests even tighter fiscal policy, which takes the burden off the Bank of England to hike interest rates, perhaps as much as markets expect. At the start of October, expectations had got excessively high towards 6%. They're now back below 5%. However, it's worth saying that the Bank of England, as of August, We're the only bank forecasting inflation back towards target by the end of next year. So there may be even less pressure for the Bank of England to raise rates in line with market expectations should the government indicate and follow through with further tax hikes. A much tighter fiscal policy here would offset the need from the Bank of England to tighten interest rates or raise interest rate policy too much. And they're meeting on Thursday, so colleagues will update you on Friday how that goes. But in summary, a genuine change in tone from markets with regards to likely path of interest rates beyond December. That is, that this year may mark the end of the aggressive global increase in interest rates that we've seen. And this would generally be positive for equities, as it would suggest markets can now focus more on the global economic cycle rather than the interest rate cycle. And it would likely be a strong support for global interest rates and for bond yields. And that is, markets could look towards bonds beginning to give a positive return, as well as equities giving a positive return through 2023. So it would have profound consequences for global portfolios and for true potential clients should the Fed and the Bank of England indicate that they too are almost done with their interest rate increases after this month's meetings. So please do join us tomorrow, where we'll set the scene for the US Federal Reserve meeting on Wednesday evening. Thank you.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.